So if you stare at the screen now, what I've done for you is I've listed all the principles again. And I know sometimes I go slow, sometimes I go fast, but it's by design. When things are really important, I want you to understand them. And this is something that applies to every project, every idea. Money, no money, this is how you should think. Okay, you should think about life, love, whatever in this way. And it'll kind of uplift you. Think about the future, think about it clearly, yet use your heart too while making decisions, right? That's finance allows you to use your head and your heart. Okay, let's move on to something that's new stuff. So before I go there, let me just revisit one idea. That is the length of the timeline, and that's another thing that I keep talking about, the timeline. But here, just a little pause. Remember I told you that the beginning of a project is an important point. But the end of the project is also an important point, and I deliberately stayed away from talking about it for a little while. And the reason is we are going to move on to the notion of bonds and stocks today. And the reason I'm going to bonds and stocks, remember, is financing. And the reason we are going to financing is because we want to figure out for this purpose, for our class, our course, we want to figure out what the cost of capital are and how do you get it. And that's what it's all about. Of course, you want to understand financing from a personal standpoint. And the nice thing about whatever we do next is bonds, stocks, risk, it's personal. In other words, you can think like an investor or a person who's going to invest later. So except for cash flow estimation for a project, which you may or may not do till you work or have an idea or whatever, you can use everything else for personal decision making and thinking. And remember, even if you don't have money, this is so cool. Okay? So let me show you what the end of the project looks like. Remember, our project was 10 years long. At the beginning, you should think of things which I said had capital in them. And they are negative usually, right? You have to spend stocks of things to start some flow. Okay, what happens here? If the project is over, you just close shop, you sell, inventory, etc. Basically, working capital comes back. And the notion is you're not going to use this working capital anymore. You also sell machines. So whatever capital happened in the beginning, you kind of undo it. It's not the same value, obviously, especially the machine. So you just undo it. And at that point, you have to take care of taxes and stuff like that. Just briefly, if a machine has been depreciated fully, and you sell it for $10, you have to pay taxes on that. On the other hand, if you haven't depreciated it fully, accounting-wise, and $10 is the value of the machine, and you haven't depreciated 5, you're allowed to depreciate 5 and pay taxes only on 5. Things like that you learn as you go along. What's important today is, suppose this is not true. Suppose you think the project will go on. And that's the difference between a project and a firm. A firm does go on, projects may or may not go on. So projects have finite lives, firms do not have finite lives when you're thinking about them in the future, right? You don't start a new idea and say, it's going to be there only for 2 years. It's not a very good new idea, and it's not an empowering way to start something. Because if you are not that excited about its longevity, nobody else is going to be, right? So what do you do here? Remember, the last cash flow here is C10. We did an example where this was 1.9 million. And this could be, hopefully, say, 20 million. That's the last period's cash flow. And what is cash flow? Net of all the expenses. Okay? So now what do you do? Suppose you expect it to go on. You figure out how long it's going to go on, take all its present value here, all the years here, future, and put it here. And you use simplistic formulas to do that. And the reason is very simple. All the value beyond year 11 to whatever, you cannot estimate precisely. In fact, I would encourage you to only do precise estimation for things that we know a lot about, right? I spoke about that. Your horizon should be dependent on how much you know, rather than, or the world knows, rather than something fixed, right? So year 11 and onwards can be thought of the following way. It's called terminal value. And we'll be using these formulas a lot today. That's why I'm introducing it. Terminal value can be thought of C11 over R minus G. Remember, I told you a formula of something that lasts forever is C over R minus G. I'm going to use it a lot today. And this is called a perpetuity. This guy is called a perpetuity. What is G? G is the growth rate. And you'll apply it to how much? 20 million. So what will C11 be? 20 times 1 plus G. How will you get G? G will be your estimation of how much growth you'll have after year 10. And what is R? R is, sorry for writing it in caps, it's our same old little r. So I just wanted to lay it all out here, is that you have two choices in a project. A project could end and you could sell the inventory, you could do all that and you could stop. Or you could think of a project like a firm which goes on forever. You can't do both. You can't stop and get value beyond year 10. We'll come back to this, and the reason I'm highlighting this is we are moving on to think about ongoing things. And ongoing things are called firms. And that's what we invest in. That's whose bonds and stocks we buy. And I think it was an important kind of midpoint to give you a sense of where we're going. What I'm going to do is I'm going to now introduce a couple of new things, and then we'll take another break. But just hang on with this. And the main topic for today and next week is going to be bonds and stocks. And the reason I gave you this idea of project versus firm is I think it's a good way to bring project analysis to the firm level and make you think about a firm. And bonds and stocks are typically issued by entities, okay? So let's get started with bonds and stocks. And today we'll spend a lot of time on bonds and try to do as much as possible. The reason I do not want to spend hours on bonds is one thing is very simple. I could teach a whole class on bonds. And the reason is bonds are typically peculiar to the US, especially in the private sector. Most bonds are loans. All bonds are eventually loans. And in most countries, loans are between you and the bank. Whereas bonds are things that are issued by entities when they borrow money. The one thing that the world does, and the US does too, is the governments issue bonds, and bonds are like IOUs. So we'll start with bonds, then talk about stocks next week. But this is where I've done most of my work. So I can get very excited, and that's the second reason I want to kind of keep it under control, is because this class is about value creation, and value creation happens through projects. The reason why we are doing bonds and stocks, as you'll see in a second, is to try to get at what is my cost of capital, what is my little r, okay? So if you understand that, please start off with why we are going on financing. So the first thing you have to always keep in mind is value is created by ideas, projects, entities, you. It's the gray matter here that creates value. Financing cannot per se be value creating. And the reason is very simple. If financing was value creating in a fundamental way, I would just call you up, sell your stock, you'd sell it back, we'd make money, share it, and move on. It cannot be possible for financing per se to create value. There are situations in which financing can create value, but those tend to be man-woman made situations, artificial, or some frictions that create value. Okay? How do you raise money to finance the idea? So now, though financing is not value creating per se by itself, if you didn't have financing, you wouldn't be able to implement the idea. Remember, I talked to you at the beginning of this class that the one fundamental principle we are going to have is democracy. And the way it's going to be reflected is through capital markets, flow of money. The only thing that I have been disappointed personally over the years is how little impact it has had on the world, not how much impact. By that I mean the following: markets are created for people, not the other way around. And if markets cannot serve democracy and do something to uplift poverty, then there's a problem. Of course, it's done a ton, but it could do much better, right? You always want to do better. Anyway, so the question here is, without markets, you can't get money. So the question is, how do you raise money? We could spend hours, in fact, months, weeks, years, whatever, on this topic, as I said. But I'm going to fundamentally talk about two kinds of financing. One is bonds, one is stocks. So why am I only restricting myself to this? For two reasons. One, as I said, the focus of this class is on value creation. The second is, if you understand these two, you understand any other kind of financing because it's a mix of the two. Snapshot of identity is extremely important, and after that I will take a break, and you should take a break too, because I think it's good to think about what we have been talking about. Real assets are on your left side. So we are not in this class talking about banks, because banks have financial assets and financial liabilities. We are talking about banks facilitating the creation of value. They do create value, but they are not the main engine drivers of new ideas and so on. Those come from creativity that requires financing. So the real assets are sitting, if you notice, on your asset side. One more time, they create cash flows and they require R. The primary reason I'm going to go to financing for this class is that I need to measure this. Cost of capital. Remember, this is called cost of capital. And you'll see later the advantages of having a market. To figure out your cost of capital, doesn't belong to you, remember? It belongs to the next best competitor. The good news is, if you have publicly traded information about equity and debt, you can do cost of capital. You can figure out and try to mimic the beauty of law and law of one price. You can value things because you know what your comparables are doing. Okay, so but please remember the identity. Value on asset side, financing, a way of figuring out cost of capital, and then financing has a lot of value on its own to learn about. I've done a lot of research in it, but I'm trying to keep you very focused. So let's take a break now. I've given you a sense of where I'm going and why I'm going, and next time when we come back after a break, however long for you, let's get into talking about debt. And by the way, debt and bonds are the same thing. Equity and shares are the same thing. This is also called stock. Okay? See you in a little. Bye.